What's the absolute best way to invest your first $100? It's a question I hear all the time, and honestly, it can feel completely overwhelming. So I thought, you know what? Instead of just giving advice, let's put it to a real test.
To get a real answer to this question, I kicked off this little experiment 4 years ago. I took $100 and split it 5 ways across 5 of the most popular investment options out there for beginners. Today, we're going to crack open the results and see which one actually came out on top.
All right, so here they are, our 5 contenders. And to keep things fair and square, we're going to judge each one on 4 key things. First, the learning curve. Basically, how hard is it to just get started? Second, passive income. Can it make you money while you sleep? Third, tax efficiency, a big one, which is all about how much of your profit you actually get to keep. And finally, the all-important risk level. How likely are you to watch your money just disappear?
First up, individual stocks. This just means buying a tiny little piece of a company you believe in. The learning curve here, I gotta say, is high. To do it right, you really need to be able to analyze financial reports and leadership teams. For passive income, it's pretty good, because a lot of stocks pay out dividends. But the risk? Oh man, it's very high. I learned this the hard way back in the dot-com bubble. I made some money, sure, but I also saw companies I own go completely bust. It's a risky game.
So for this experiment, I wanted to keep it totally random. I literally put about 20 company names on a board, put on a blindfold, and threw a dart. And bam, it landed on Samsung. So the big question is, after 4 years, what happened to that $100?
Yeah, not great. That $100 investment is now worth just under $68, a loss of over 32%. I mean, I earned a few cents in dividends, but that barely made a dent. This result just perfectly shows how much of a coin toss picking a single stock can really be.
And check this out. This is where it gets crazy. If that dart had landed just a little differently, the story would be completely different. That same $100 in Apple would be worth $170 today. And in Nvidia, get this, an incredible $988. It just goes to show how much of this can really come down to pure dumb luck.
Okay, let's move on to our second contender, real estate investment trusts, or REITs. The easiest way to think about it is like this. You and a few thousand other people all pool your money together to buy a huge commercial property, like an office building or a shopping mall. Then, you all get to share in the rental income. The learning curve is moderate, the risk is medium, and the passive income potential is fantastic. They're actually required by law to pay out 90% of their profits to investors like you.
So after 4 years, my $100 grew to about $110. Now what's fascinating here is that the value of the property fund itself actually dropped a little bit. But, and this is the cool part, those powerful, consistent dividends from all that rental income more than covered that loss, pushing the entire investment into the green. That, right there, is passive income doing its job.
Next up, the wild card, cryptocurrency. We're talking digital money, like Bitcoin, that isn't controlled by any government or bank. It's famous for making some people ridiculously wealthy and for losing fortunes for others. The learning curve is moderate, tax efficiency is pretty poor, and the risk level, well, it's very, very high. This is absolutely not for the faint of heart.
And wow, the result is just staggering. My $100 investment in Bitcoin exploded to over $650. That's a 550% return. But, and I cannot stress this enough, this is an outlier. This is not normal. While Bitcoin was the best performing asset of the last decade, the vast majority of other cryptocurrencies go straight to zero. This is the very definition of high risk, high reward.
All right, let's calm things down a bit with contender number 4, good old gold. For literally thousands of years, gold has been seen as a safe haven asset. It's where people put their money to protect it during uncertain times. Like when inflation is running wild. The learning curve is low, but it pays zero passive income. It's an asset for protecting your wealth, not necessarily for growing it like crazy.
And my $100 in a gold fund is now worth about $140, a solid 40% return. It's not as exciting as Bitcoin, but it's steady, reliable growth. This performance shows exactly why people trust gold to hold its value and act as a reliable store of wealth.
Okay, let's move on to our final contender, index funds. Imagine buying a basket that holds a tiny piece of hundreds of the biggest companies. I'm talking Apple, Microsoft, Amazon, all at once. That's an index fund. You're not betting on one company, you're betting on the entire market as a whole.
The learning curve is super low, the risk is low thanks to all that diversification, and the tax efficiency is great.
So, how did the index fund do? Well, my $100 is now worth almost $180, a return of nearly 80%. This result right here shows exactly why index funds are such a favorite for so many long-term investors. They're simple, they're low cost, and they have a long history of delivering really solid, consistent returns.
So here it is, the final scoreboard. I mean, on paper, cryptocurrency was the runaway winner, there's just no question. But that win came with some heart-stopping volatility along the way. What's just as important, though, is the performance of the others. The index fund delivered an outstanding 80% return with much lower risk, and even the safe options like gold and REITs provided solid, steady growth.
So what's the main takeaway from all of this? It's simple, really. The most important thing you can possibly do is just start. Even a small amount, like the $100 we used here, can grow into something significant over time, all thanks to the power of compounding. Time truly is your greatest asset in this game, so don't wait to get started.
So after seeing all the risks, the rewards, and the real-world results from this 4-year experiment, I'll just leave you with one final question to think about. What will be your first move? Thanks for watching.